Welcome over another episode of Financial 15. Lots of great information today. We're going to go through a complicated tax item, but it's important. If you have a corporate account, this strategy can help you take taxable corporate dollars and change them into tax-free dollars, which of course is what everybody wants. You'll definitely want to stick around.
Yeah, another moment in our series on insurance, things that you should be knowing about. There's more to just finance than just dealing with stocks and bonds. Today, as Clint mentioned, we're dealing with corporations and we're dealing with how to get money tax-free, what you could consider sort of to be a corporate TFSA, if you will. We want to make sure on that. If you want to see this or any of the other videos we've gone, please go to our YouTube channel and subscribe. Click the buttons, really easy, great content review. Also, like us on Facebook, and most importantly, please go to our website at beckerrohr.com. Blogs, events, videos, everything that you need for your financial well-being. But today, change taxable corporate dollars to tax-free. Clint, what are we talking about? Are we dealing with this on our own, or do we have extra help?
Of course we have extra help. It's a complicated topic here. We have to bring in Adam Buss, the Wealth and Estate Planning Specialist, to walk us through the details here. Welcome again to Financial 15, Adam.
Thank you. Again, good to be here.
Excellent. Well, we'll just dive right in. I'm going to pull up a chart here. It's going to give us the basic concept, and there's a lot going on, so I'll make it full screen. And Adam, why don't you walk us through the details here?
So when we're looking at insurance, especially corporately owned life insurance, in this case, we're looking at something called whole life insurance. So it's a type of permanent insurance that is designed to pay out eventually when you pass away. So the importance of this is we're not looking at a temporary need. We're looking at something that is a permanent problem, often a tax problem, especially when it comes to corporations and estate planning for those that do have corporations. So we want to help prevent and solve the tax problem that is, extra cash or assets that are building up in the corporation that really lead to a tax problem on the estate. Okay, so that's why we use a permanent strategy to solve that, essentially a permanent problem down the road. So how does it work? We're basically trying to, tax shelter, tax exempt some funds into a life insurance policy. So essentially you got a couple different options on the corporate side. So option one, you say, hey, we got some extra cash in the corporation. We're going to continue investing it with the Becker-Orr team, obviously, and have that money grow inside that company. But eventually you got to get that cash out, right? And that's where it does lead to the tax bill. So again, it's do I slowly dividend out the cash, but this is cash I don't need anyways. This is really just money I'm saving as legacy dollars for my family. Then they're going to have the problem is how do they get the money out? So even though the corporation doesn't die, the shareholders do. And when the shareholder passes away, the value of their shares is taxed at that point in time, which leads to the tax bill on death. So that can be quite a substantial tax bill for a lot of people as they have a fair amount of wealth that might have built up in their corporation. And if we look at, what happens if that value is often in real estate, well, the only way to change that would be to sell the real estate at some point in time. And then again, the cash is still stuck inside that corporation. So how do you get it out by paying as little as tax as possible? Well, that's where option two comes in. We want to use, it's called a tax-exempt life insurance policy. So it's probably one of the best strategies that is still available to people that have corporations. CRA certainly over the years has taken a lot of fun planning strategies out of the equation, unfortunately, for small businesses. But one of the ones that still exists and is probably the most powerful option is using a tax-exempt life insurance policy. And how the process works is we're going to take some of that surplus cash, either cash flow or money that's just sitting there invested, that's earmarked to go towards the kids or the estate down the road anyways, and try to turn it into tax-free money in the end. So what we do is use some of that cash. There's a pot of money that's built up in the investment account. We'll slowly trickle that into an insurance policy through the premium. So just as Kevin mentioned, you're probably used to moving money over to a tax-free savings account every year on the personal side. This is the same concept on the corporate side. You're basically just moving money from one pocket to another pocket that happens to be tax exempt, and it also just happens to be called life insurance. And then down the road, the insurance proceeds, when you pass away, pay out to the corporation completely tax-free. And usually a good chunk of that money that gets paid out forms what's called the CDA credit, or capital dividend account credit. That is just really a notional account behind the scenes that the CRA and your accountant track, and that money can flow out 100% tax-free to the shareholders or your end beneficiaries down the road. So you're taking that money that would have been taxable to get out of the company and changing it to tax-free money in the end for the people that you care most about, which is probably your family or your financial advisor, whichever one happens.
Exactly. Yeah, that's an excellent concept and a great way to deal with these things. But I keep looking at something out there. It's, after tax from corporate, tax on income, tax on debt. How do you sort of avoid the triple taxation, if you will, or the potential triple tax on the estate that's going to go on?
So that can certainly lead to a very large problem that is too often overlooked, which is, a potential for double tax or triple tax at the estate level. So let's use an example of, I have a portfolio of investments. The Becker Orr team has done a great job. There's some capital gains that have accumulated on those funds. But when I die, I'm taxed at the estate level based on my share value of the overall shares. So let's just say it's the portfolio. But that just means that the estate's paid tax. The money is still stuck in the corporation. Okay. Well, to get the money out of the corporation, so my estate paid tax on it, they have to sell those investments, pay taxes inside the corporation, and then they have to pay tax through a dividend to get the money out of the corporation. Okay. So my estate paid taxes, the corporation paid taxes on liquidating the portfolio, and the beneficiaries paid a tax on the dividends for it to come out. I mean, yes, I'm sure any accountants listening to this will say there's a couple different strategies that could be put in place to try to minimize that impact, but it's not eliminating it completely. Okay, so again, it always comes down to proper planning that can be put in place to try to minimize that tax bill. I don't know about you, but if I had a corporation, I'd rather give the bulk of my money to my family versus 50 to 75% of it going to the government.
Yeah, that's usually a good option. Most folks don't want to give all their funds to the government, but we kind of outlined the high concept of the strategy there, hit the tax benefits, can really bring it home and show some numbers comparing one strategy to another. And I'll scroll down here so we can access that and walk people through it.
So this is one example through one life insurance company, and it's just a matter of kind of using their graph. So we happen to use Equitable Life. As being an insurance broker and specialist, my job is to look at all the different options, find the right structure that fits for your particular situation, your goals and objectives. So this is a quote. Obviously, pricing and payouts change based on health, smoking, ages, all of those things. But this is just one particular example. So here, the biggest question is, well, why don't I just leave the money invested? Like, wouldn't I be further ahead given my portfolio and the great job, again, the Becker Orr team is doing on my portfolio, just to leave the money invested? Well, insurance is a bit more of a fixed income style asset class. So view it as an asset class. So you are getting, a rate of return on the deposits, the premium that you're paying into the policy. But how does that compare? What do you have to get as a rate of return to be equivalent to the value you're getting on the estate in the end? So here, this one example using current dividend scale, the insurance at life expectancy, in this case we said age 85, is a after-tax rate of return of 4.78%. That is a pretty darn good rate of return for an internal rate of return on the policy.
Yeah.
Okay, how does that compare? What would I have to get on my portfolio in order to match that payout to the beneficiaries? Well, if I was getting interest income, which is obviously the least tax efficient, I have to get a 9% rate. I don't know about you, but I don't think there's any 9% GICs that exist today. If you can find one, good for you. But having that level of guarantee of an interest rate over the next 30, 40 years, I think that's pretty hard to come by. I mean, yes, there are some other options for dividends, capital gains, but it's still a higher bar that you have to achieve to maintain that same level of payout in the end for the beneficiaries. And of course, the life insurance is meant to be fixed income style, so it's on a reduced risk basis. That's kind of given a quick comparison as to how it compares for internal rate of return. Obviously, a number of different ways policies like this can be structured, and we want to structure it to accomplish your particular set of goals and objectives.
Yeah, and we're talking a high level here. And Kevin, were you about to jump in as well?
No, completely with what you said. I say, yeah, I mean, basically, anytime you can turn dollars into something that's tax-free, I think it makes it worthwhile. Less money going into the government scenario, more money in your pockets, and as you've mentioned many times, into that of the individuals, your family, your friends, whoever's going to be getting the money at the end of the day. It makes a lot of sense. That's what I was going to add as a point.
Yeah, and what I'd mention is we're high-level concept here. There's a lot of nuance, a lot of detail. If you're going to be implementing this strategy within a corporate structure, it can be very beneficial, as Adam just mentioned. But a key takeaway is you definitely need to have a plan. If you're going to be putting this into place, you want to make sure all the numbers are crunched so that it makes sense, and you will get the most tax benefit out of it while realizing your overall financial objectives. So you do have to have a plan. These can get detailed with this strategy, but definitely one to consider if you have a corporate account so you can save some of those tax dollars. Now, before we sign off here, Kevin, people are going to have questions. This is a complicated strategy. Everyone wants to save some tax. How do they get a hold of us?
If you want to get a hold of us, by all means, please go and visit chatwithclintonandkevin.com. Let us know what the questions are. If we can't answer it immediately, we will make sure that Adam is in touch with you and can help you with this sort of a plan moving forward. He is our wealth and financial planning specialist, as well as our insurance guru. And by the way, if you need a mortgage, you can deal with that one as well. So please visit chatwithclintonandkevin.com. Questions there. We are more than happy to help you through this construct, as well as any of the other plan or options that we've come up with going forward.
Mm-hmm. And going forward, Adam, I'm going to be calling you a guru just because it's far more fun to say than specialist.
I prefer that as well. So by all means, feel free to call me the guru. I like that.
We'll leave it there. Take care, everyone. We're back again soon with another video.
Take care.